my NCBA colleagues, available guests, members of the Fourth Estate, thank you for being here. Good morning. My name is Nelly Wainaina, and I'm the Group Director, Marketing, Communication, and Citizenship. Welcome to the Half-1 NCBA Financial Results Announcement. And on behalf of the Board of Directors, the Executive Committee, and the staff of NCBA, we thank you for making time today. Ladies and gentlemen, while the results of our business are critical to delivering shareholder value, we are also driven by our purpose, which is to inspire greatness every day for all our stakeholders. What inspiring greatness means for NCBA and the people we serve is to dream bigger, to strive further, to hustle harder, to move up, to move on, to fear less, and to do more. Today, we'll kick off the financial results with an overview from our Group Managing Director, Mr. John Gashora. We'll then deep dive into our financial results. That's by David Aboga, our Group Director, Finance, and then we'll have a Q&A for 20 minutes. We believe 20 minutes will be sufficient for the engagement with the executive. So we'll be joined by the panel, that's Louisa and Raphael, and our Group Managing Director and our Group Director, Finance. From there, we'll then have a media corner with our Group Managing Director for any special questions from the media team. Our media hashtag today on socials is NCBA Half-1 Results 2023. It is now my pleasure to invite our NCBA Group Managing Director, Mr. John Gashora, to share an overview of our financial results for the first half year. Karibu, Mr. Gashora. Yeah.
Thank you, Nelly. Good morning, everyone, and welcome to today's breakfast conversation. I call it a conversation because it really should be. You've seen the results, they're in the papers, so we're not here to tell you too much about the results. We're here to answer any pertinent questions you may have about the numbers that we printed in the papers. I think obviously it's coming in the background of what I consider to have been a difficult half year. I think all across, when you look at the results that the banks are presenting, it's been one half year where we have had to work extremely closely with our customers, extremely closely with our stakeholders to ensure that we meet the aspirations of obviously the shareholders and the and other stakeholders. Also, of course, we have had various changes to do with the government. We have new governor, new deputy governor, such changes in the central bank. And whereas there are changes already we have seen in terms of the way the new administration is viewing, forex markets and other markets, if I may. The good thing is, as NCBA, we play by the rules. And so we've been working closely with the government and with our regulator to ensure that whatever changes are being made, we are part of that conversation. So today, I think I want to ensure that we get the key points from this conversation. And one is that despite what I call the difficult macroeconomic situation we find ourselves in, NCBA continues to perform, delivering 20% growth on our profit after tax year over year. More importantly, we continue to be true to our strategy, so we're still executing on our strategy. And as per our strategy, which we shall walk through again, just for a reminder, we continue to invest in branches. This year alone, we have about 8 branches already operating. We've launched 5 of those, and 3 are to be launched within the next 1 month. But the doors are open to those branches. So 8 branches already built, with a target between 10 and 15 branches to be done this year. So we continue to invest At the point of the merger, we were in 15 counties. Now we're in 24 counties. And this is something that we've consistently said that we want to continue to expand. That story is true even in Rwanda, it's true in Uganda, where we're opening new branches as well. I think the other thing that you would take away is that of the branches that we've opened since the merger, and remembering this is fourth year, we didn't open branches in 2020 because of COVID. So everything started in the second half on 2021. Since we merged, the branches we have opened, about 16 of them, 6 of them are already profitable. 6 of those branches are already profitable. And as a cohort, because we track them as a cohort, that cohort today is able to pay for itself. Those 16 branches are able to pay for themselves. So really our strategy is bearing fruit. You'll take away messages about the more digitized approach to our customers. Again, really very thoughtful approach to how we speak to our customers through our digital channels, investing a lot into our digital channels that we speak to our customers with. So again, you'll take away a bit of that. We'll tell you a bit of what's going on there. And then when you look at the financial drivers, which we shall again delve into, I think one of the big conversation has been deposits. And the reason has been a big conversation is because of two things. One is obviously the G2G deal that was done. I think there's a lot of conversation about how much that will shift deposits towards those who participate in it. And I think the other conversation has been just the political situation we find ourselves in. I think I've said this before, that we have a very diversified client base, contrary to what you might have heard about having big government base. We're a very diversified client base, and you see that our deposits have grown significantly, even quarter over quarter, from last quarter to this quarter, a significant growth in deposits, and we're just seeing really good momentum without paying exorbitantly for our deposits. Deposits have become expensive across the board, and I think we have been paying within the market, nothing more exorbitant than the market. You see increased lending, which really is a message of us continuing to support our customers. We want to stay close to our customers, and so we continue to support them. 17% growth year over year in our lending. Digital disbursements. Again, this is a topical issue because obviously there are changes we made to Fuliza, which we talked about at the end of the year. The changes that we made last year to Fuliza. I think there were conversations about the tough economic period, and that's how that is going to affect digital disbursements. And of course, the Hustler Fund. I think you've all wondered how the Hustler Fund is going to affect the traditional business that we have in Mshwari and Fuliza. And I think the point we want to make is that we continue to invest in that business. We've seen very good growth, 35% growth in disbursements year over year. So significant growth coming in at 458 billion by half year of disbursements. And I think the other point from a financial perspective, the question that you all raised, a lot of you raised last time, was about the subsidiaries contribution. I remember we talked about the fact that Tanzania was heavily loss-making, and as a cohort, what we call the subsidiaries were actually loss-making at about 178 million of losses last year. I think what you see, and we did say we were investing a lot into the business models, operating models, into cost, and many other things, and even the type of customers we're targeting in these markets for turnaround plan. I think we'll demonstrate that turnaround plan has actually worked and made significant contribution to the bottom line, going from a 1% contribution a year ago to 14% contribution this year. And lastly, I think the other conversation I have seen a lot is about dividends. Again, key message here is we continue to be truthful to our promise that unless we can find a compelling investment option, we will try as much as possible to give cash back to our shareholders. So announcing an interim dividend of shillings 175 per share. So a significant dividend to our shareholders. So those are the key messages that we'll be, double tapping on and talking through during this time. I think very quickly, this is not new to a lot of you, but who we are. We look at ourselves in three dimensions. The first dimension is what we call the core bank. And these are banks in Kenya, a core bank in Kenya, or a traditional bank in Kenya, Uganda, Tanzania, and Rwanda. And then we have a digital business. So within our digital business is where you'll find Mshwari, you'll find Fuliza, you'll find Mocash, you'll find Empower in Tanzania, you will find Loop. That's our digital business. That's the other business that we look at. The other prism we look at is what we call the non-core businesses, and that would be our leasing business, our investment bank business, and the insurance agency business. So that's how we talk about our business internally and how we track performance and the relationships across these and values has not changed. Our current strategy comes to an end of next year, but as of now, nothing has changed in terms of our strategy, in terms of our purpose and values, which is to inspire greatness, to inspire growth. That continues to be. And our values, driven, open, responsive, and trusted. We talk a lot about these values because obviously we've been going through a merger for the last few years. When you go through a merger, the one thing that you have to really invest in is building a culture. And culture is really, the catchment point for culture is the values that you create. So that's why we keep talking about our values. This just shows the regional footprint. And the numbers to the right talk about the customers that we serve, 63 million customers across all our channels, including our digital channels, in 5 countries today. So we're in Kenya, Uganda, Tanzania, Rwanda, and in Ivory Coast. We serve about 6 million customers in Ivory Coast today. So I think you see it on our screen there. And then staff, we are now at 3,300 staff. Let me just take you back to the merger we were about, that we have created another 1,000 jobs since. And I think that should give you a very good idea of the type of. Lastly, is that what we are doing has not gone unnoticed, yeah? And this is always good to see other people notice it. One thing not to do, and this we are very clear about, and I've seen questions on Twitter more is a result of the hard work of the 3,300 staff that show up every day to propel NCBA to what it is today. The leadership of that group of staff is here in front of you. Most of them don't need introduction, but the ones in the room, I think all of them will have a chance to come on stage and say hello to you and make some presentation or another today. So that's the group that leads the organization. So let's go to the operating environment. And for this, I'll ask our group director for global markets and our chief economist, Rafael Lagoon.
Well, good morning. Thank you, John. Thank you for that overview, and thank you for your leadership. Good morning, everyone. Very good to see you. I think it's been a very busy week for business journalists. I recognize that these parades have been ongoing. But if there's one bank whose parade has you in mind, I think it's NCBA. I think none of them is betting on your dreams. We do. So welcome. I'll be very brief. I think John has already actually cast it very clearly. It's been a very difficult macroeconomic environment. That's the context with which most of these results should be read. Difficult as it is, as of July, there's a glimmer of hope. So you've seen at the global level, we do have pointed resilience, whereby we're seeing some green shoots. Especially coming out of the OECD world, led by the US. So the IMF has just revised the forecast. I'm sure you've all seen that, by about 20 basis points, from 2.8 as at April to about 3, and that's where we all take as a baseline for closure for 2023. Now, the resilience, of course, is going on against significant headwinds, particularly on cost of living, i.e. inflation. So across the OECD world, we've seen significant responses to the monetary policy action. There's vast improvement. So especially in the US, you've seen that come down to 3.2. However, keep in mind that the comfort levels for inflation remains 2% target. There's a very interesting debate now whether or not 2% target level is actually appropriate given the structural changes that you've seen across economies. But that still remains a central bank target world over, and to that extent, everyone is falling off. So you'd expect that the tighter monetary policy actions will continue. Of course, with that tightness, it's a very, very difficult external financial environment for all of us. And Kenya being an off-taker of that, of course, you can all imagine the conversations there too. In the region, as I said, I think we're seeing mixed signals though. So if you take Uganda, for instance, we are seeing very significant macroeconomic stability. That's the only aberration. Rwanda, Tanzania, and Kenya, the largest, pulling on lockstep. Uganda is a bit aberrational. I'm sure you all follow that. And I think it's arguable that their decisions prior to COVID seem to be paying off. If you recall, Uganda has been the most flexible, especially on the financial market side, to the extent that the currency flexibility, I think at some point, cost them very dearly into the COVID season. It would seem that that was wise. And what you're seeing is growth of about 4.9, but within very low and stable inflation numbers. So for instance, if you saw their monetary policy decision just last week, it's pointing to that liftoff. And that's the only aberration. The rest of us in the region, Tanzania, as I've said, Kenya and Rwanda, are pulling on one side. Rwanda especially, with notably very high inflation, and still, or of course, dropping to 17, but remains quite intransigent. Now, difference in terms of just the, let me say, divergent paths for monetary policy. So Uganda has gone down. Rwanda is up, primarily to address inflation, which is still way, way, way into the depths of double digit. Kenya, which is where we are just in closing, I think we all are very closer to this. So I'm sure some of you write about this every day. Our baseline assumption is that the disruption from the 2021 rebound perhaps is sort of plateauing. Okay, so we saw 4.8 from 7.6. That's a drastic disruption of that post-COVID rebound, which I think was significant. Up to half year, you can see Q1 numbers were pretty strong at 5.3, just under 5%. The new inclusion away from the 2021 growth numbers, of course, was the return of agriculture. I don't know what the numbers you have seen, but the baseline from a contraction of 1.7 gives you a good sense of where the 5.3 came from. So industry and services came out strong for most of post-COVID season, but we didn't have agriculture, hence the drop to 4.8. With the return of agriculture for Q1, you're seeing that sort of better number for the first half. However, on the challenges stemming from just the counter-cyclical policy responses we've seen being applied, and how it's paying off on the key targets, especially inflation. So that's back to band to just under 7.5, 7.3 to be precise. But if you look at the headline number and strip off the non-food, non-fuel, you see some level of intransigence on that number, suggesting that even the 10.5 CBR move maybe with that for a while. And if you factor in the exchange rate pass-through effects onto inflation, you begin to see that you'll have significant sort of higher monetary policy-based assumptions going into the end year. Now, if that is a financial environment, of course, you test on the sovereign repricing significantly, be it on the monthly bond auctions, but also on the weekly T-bill auctions. So rates as high as 13.5 and still growing. Of course, you can see how that can translate into difficult business conditions. And of course, that is hurtful to growth. Now, that's the bad news, the gloom. On the positive side is, as John has already mentioned, we saw a very successful transition. And this is often understated, especially because of our politics. The transition is now blowing warts and all and implementing its policies, whether or not you agree with them. But the implementation of that policy is supposed to give us some sort of liftoff. In our assessment, just the dividends from that, some positivity into this as they translate to market factors stay.
Good morning. It's to be a little more energy in the room. We're reporting good results. As John said, my name is Louisa Wandabo. I'm the Director of Strategy and Chief of Staff at the group. And today I have the pleasure of speaking to you about our strategy. The numbers that you've seen today are not a function of just walking and throwing money around. They're actually a function of our investment and our focus in delivering on the 5 priorities that we set out in 2020. These are to become a distinguished brand known for customer experience, to scale our retail banking and especially expanding our distribution in our core markets, to deepen our leadership in our core mainstays of corporate banking and asset finance, and to transform ourselves both internally and externally in how we serve our customers. All of this underpinned by a very strong culture that delivers on performance. And the numbers on the right-hand side in terms of profitability, in terms of return, are a testament that this investment is bearing fruit. actually, the contribution of our business, as John said, we do look at our business through three different lenses. One is the core bank versus the non-banking subsidiaries, and then also the digital business that has been very strong over the years. We are the home of Mshwari, we are the home of Fuliza. And what we've seen in the last year is we've been able to see contribution from our core bank subsidiaries in the region, particularly Tanzania, showing really good upswing in performance on the back of the turnaround efforts that we delivered last year. Tanzania last year delivered $709 Kenya shillings loss. That has turned to almost, it's 1 billion shillings upswing to 250 million in half one 2023, a function of rethinking our business model, rethinking our operating model, really retrofitting our business for performance. And we're very proud that this business is now contributing to our bottom line. The digital business in Kenya has seen some pressure on the back of the pricing changes that we made to Fuliza. But as John highlighted, what we're very excited about is that disbursements continue to be very strong, 35% up year on year. The rest of the region is also performing very well, with Empower in Tanzania, Mokash in Uganda, and Mokash in Rwanda contributing to the bottom line. Jumping onto our strategy, as John said, we've been on our path to grow our branch network. We now have 107 branches across the markets that we operate in. We're present in 24 counties here in Kenya, and are really invested in this idea that the more that we invest in getting closer to our customers through these branch networks, we are going to grow our business, become more relevant to the customers that we serve, and indeed to the greater nation. What we're excited about is that that investment is coming through in the strategic intent around our cost of funding. Our CASA ratio before, for the full group, is at about 52-48, but these new branches are actually delivering a better cost of funding at a 79-21 mix. The cost of funding is at 1%, really helping us address some of our traditional issues. And what we're also excited about is that deposits are coming through for our retail business. The bottom right-hand side of the slide in front of you shows that we've been able to grow retail deposits despite this challenging macroeconomic conditions by about 22% year on year, and are now at 143 billion. So we are on the path to growing that branch network to deliver more cost efficiency and to really widen our customer base. Furthermore, when we think about our traditional mainstays and the strengths that we've had, particularly in asset finance, we're very proud that 1 out of every 3 cars in front of you are financed by NCBA, and we're not taking this for granted. We continue to invest in digitizing that experience. I think you've all seen the billboards around. You can get an application and have it approved within less than 15 seconds. But, you know, proud to partner with KMI and be the headline sponsor of the Motor Show this September, where we're excited to meet with over 10,000 customers who are excited about cars, and we are available to finance those cars. The income from this business continues to be very strong, despite us having a fairly substantial business. 35% year-on-year growth is certainly nothing to smirk at. On digital disbursements, this is a number that John highlighted. With all of the components of that delivering on their own, Fuliza has grown to 391 billion in disbursements. Over small deposits from Mamambogas across the country have brought on more than 40 billion of deposits, which really shows that these investments that we made many years ago to enable continue to bear fruit for our business. And yes, we're not staying stagnant. We've talked about Loop in the past in this room or in other fora, where we said that we were investing and continuing to relentlessly think about what does customer experience, digitized customer experience for the future look like, so that we can bring on board new customers that are excited and eager to engage with financial services very differently. So we've been on a soft last. But what we want to remind you of is 3 messages. Loop exists to free customers and ensure that they have all of their financial services in one centralized location. Whether you bank with a competitor, we hope that you don't, but if you do, you can use Loop. You can connect your cards, use it to pay for your payments, use it to pay for Netflix. We are completely not discriminating against other banking partners. Secondly, we think that we've brought on board a premier shopping destination for our customers. You can get unmatched discounts that are personalized to you, discover merchants around you, and really get value, particularly in these tough economic times. Thirdly, we know how to do digital credit very well. We know how to do it at scale, and we know how to do it in a profitable manner. We are continuing to invest in that digitized lending experience. Not to social media responses and fill in forms, but to really engage in the selling experience and in the service experience. And we're glad that this investment is bearing fruit with those 1,900 hours that have been served so far. And this is just the beginning. As John mentioned, we've also been investing in upgrading our NCBA Now mobile platform. And we're continuing to add new services that matter to our customers in terms of investing capabilities, in terms of insurance capabilities, in terms of traditional payment capabilities with integration with the likes of KRA. In the background, we're spending a lot of money in modernizing our infrastructure. We're adopting new technologies such as cloud. We're adopting open banking to enable partners to be able to be part of the NCBA ecosystem. And we are awake to the risks of the day in terms of cyber infrastructure, in terms of cyber risks, and are investing appropriately to mature our infrastructure. We're excited that Banan to think about the app, that they're seeing value, and that the services that we're offering on the app are very relevant and are actually driving that transactional volume increase that you see on the bottom right-hand side of 36% growth in transaction volumes year on year. So from my end, I think we're in a good place. Half one has been tough. The macroeconomic conditions are tight. But NCBA is not a bank to be uncomfortable by challenge. If anything, we stand up to that challenge and we stay the course with our strategy. We continue to invest, we continue to tweak, and we continue to come back to all of you to deliver on what did we say we were going to do, and did we do it, and did we actually deliver returns? So I'll hand over to my colleague David to walk you through the numbers in greater detail. Thank you.
I think picking up from where my colleagues have left off, really, the GMD, John, Raphael, Louisa, I feel like I have the easier and the most boring part of the conversation. But I think we set off to say, let's have a conversation, not necessarily let's make a presentation, right, about what the half one has been about for us and where have we landed from a number perspective. So let me begin by, I think Louisa did talk through or John, the 5 strategic priorities for the group. And in those 5 strategic priorities for the last 5 years, those have been our strategic priorities. However, every year we will look at what are the business priorities for that particular year. And for this year, we did set out 5 key areas that required greater attention. The balance sheet optimization, how do we just get value from our balance sheet, customer growth, control environment, and how do we improve that, subsidiaries contribution, given where we were coming from last year, and sustainability. So these have been the 5 as receiving greater management attention, and part of it in terms of what has been the impact of us really focusing on these 5 key themes. In the results that we released yesterday, I think if I just started off with the balance sheet side, we are now a 660 billion size group from a total asset perspective. If the currency was better than where it is now, we would say we're a $5 billion business, right? I think, Raphael, we can still say that, right? We're a $5 billion business, and that's a sizable business. If you remember, I think 3 years ago, we were probably at about 490 or thereabout when we merged, 490 billion. Close to 35% from that time. We're now 35% larger than where we were. What drives that balance sheet has really been years, and this really just speaks to group, to our customer base, and we'll talk a bit about this in detail. Our lending, and I think you've seen this number, 324 billion. We are 46 billion up over where we were last year from extending credit and supporting our customers to meet their particular goals and objectives. And the impact of all that is that our total income, we're reporting a half-year income of 31.2 billion, and resulting in a profit before tax for the group of 12.4 billion, which is 11% up from where we were last year. We will delve a bit deeper, so it's been said before. Subsidiary contribution was a key priority. The pie chart on the left contributed 1% of group profitability on a combined basis. This is the regional subsidiaries then from a country just about 100%. And that drag was really because of Tanzania. Tanzania had a negative contribution last year, 664 million of loss, or one could say actually a 6% drag on that particular profitability. But the rest of the subsidiaries then, Uganda, Rwanda, and the other non-bank were actually positive. But fast track to this year, if you look at our subs today, they're probably, 10% of the group, whether you take total assets, total deposits, total lending. The subsidiaries are about 10% of the group. And you can see the contribution from our profitability now is 14%. So they're actually getting their rightful contribution to the group profitability. We still recognize, obviously, Kenya is still the flagship of the group performance with 86% of our PBT coming from the Kenyan business. Last year, and I'll just talk about the subsidiaries in a very little detail. The last year, we did invest about 2 billion shillings in Tanzania, if you remember. 2 billion shillings of capital to enable that business achieve its turnaround objectives. We right-sized our distribution and our network and staff complement in that market. And we also enhanced our risk management practices there in terms of just credit quality and how we go about business. So we can see that that is actually indeed bearing fruit. Uganda, on the other hand, has been pretty stable. If you remember 2 years ago or even last year, Uganda was just coming out of the COVID period after a long sustained lockdown. And our digital business there had suffered quite some losses in last year and the previous year. We've seen very good recovery, especially on the digital side from that market. We continue to go after, new customer, new business. Our deposits in that market are growing faster than our lending. And obviously, we do have some work to do there in terms of just getting our credit extension up to where we want it to be at. But I wanted to mention Rwanda, and Rwanda is probably the fastest growing subsidiary in the group. Small, we've got an asset base of that's lending about 12 billion. But that business in Rwanda, there is actually 40% growth in Rwanda to that 16 billion number. Our lending is 72% up over previous year in Rwanda to 12 billion. So we're seeing an extremely fast growth of our Rwanda subsidiary, and I think it's contributing significantly then to the group performance. Moving from the subs, deposits, and I think John spent some time on this. I think you see that 10% increase in our deposit base, or 48 billion over where we were last year. And that really just speaks to some of the business actions that we continue to drive. Raphael told us about the macro. So there's obviously a lot of deposit repricing, but we continue to deepen that customer relationship. We continue to win new customers across the marketplace. And if you look at our business, we're more than just a deposit-taking business. What we are looking at doing is managing operating accounts for most of our clients. And that's the kind of conversations that we are having with our customers, so that at the end of the day, we can grow both the volume of deposits from existing as well as new customers. So it's not just new customers. When you think about our business in Kenya and slowly turning onto the rightness, we probably have 50% of our deposit base will be contributed, so that the retail business has actually grown faster. 20% growth in deposits for the retail business. Our corporate business across has been more or less flat, but and maybe secondly is also to mention that we, as a group, about close to 30% of our deposit base is foreign currency based. And then you've got about 70 that's local currency. And that's what gives us that opportunity to be able to actually, offer our customers some of that FX that they badly need in this current environment. From a CASA perspective, and again, not to repeat or rehash, we moved from 2 years ago, almost 50-50. You can see that tilt is happening. Our CASA mix now is 52-48%. And our near-term target is actually to get to a 60-40. Because then that's what will significantly improve our cost of our deposits, our wholesale. You know where the market rates are, and that does have an impact on our cost of funding today. If we move to the lending side, I think, as I said earlier, 46 billion growth in lending across the group. And really, we've across the group, but with progressively reducing our non-performing loan ratio. You remember 2 years ago, we had a high of about 16.3%. Our non-performing loan ratio as a group now is 13.2%. That is a factor of have normalized, moved from the non-performing loan category, but we've also gone after resolution of some of the existing non-performing loan stock. You will appreciate that it's always slow in this market to either realize collateral or just to reach settlement with customers who are in a difficult place. So that process is very slow. But if you look at our balance sheet from a group perspective and the disclosures we've made, there is some growth in the stock of non-performing loans, but for 3 reasons. One is not because there's been necessarily deterioration, but some of that is dollar denominated. If you look at the shilling depreciation, means obviously the stock has gone up. And then secondly, for some of these facilities, I mean, you continue stock creation, and we continue the resolution efforts. I think we've made quite some successes on the resolution side of it. And when we compare with the industry, I think you can see NCBA group at 13.2. The latest we had on the Kenyan side especially is that we are at about 14.5% non-performing loan ratio in the industry. And I think you've seen there, we put a comparator with 3 of our peers, one below us, but the 2, peer 2 and peer 3 at 14.3 and 17.5 actually have a much higher non-performing loan ratio than we do. So we are obviously focused, and you did see in our strategy, enhancing risk culture is something that we are focused. It obviously optimization efforts have delivered. I think there's always been concern. We've had conversations here in the past about your cost of funding. As NCBA is too high, are you able to grow your NIM compressions in the near term and the near future? But you can see from the 3-year sort of trajectory that we have actually improved our NIM, despite the increase in that cost of funding, because of really optimizing our earning assets and making sure that we price our assets correctly and that we're also investing properly. So with a NIM of 6% in this environment, and almost 2-3 years ago, I think the group then has made quite some good progress in that. If you look at the right-hand side bridge, I think just showing you between last year and now, you can see that interest income has grown faster than, and that talks to both rate and volume. Obviously, on the interest income side, you've seen lending rates grow. We've been able to pass not the entire market adjustment to our customers. I think we've passed part of it to our customers. If we were to pass the entire market adjustment of where the interest rates are, then you'd probably see that yield being much, much higher. But we've only passed part of it and had to absorb quite a bit of it. And on the cost of funding side, I think you can only participate where the market is. And our branch network should help us be able to significantly reduce some of these cost of funding pressures that we see. As I think I've talked about the deposit side of things, but as we continue to, increase our relationship with our customers, I think if you look at the right side box in terms of our contribution to non-funded income. Now, again, we've just done a bridge from where were we last year so that you can understand that journey of the last 12 months and how has it been like. So the group's FX income is about $1 billion lower than where we were last year. Again, for good reason. Obviously, last year, when a different environment, margins were a lot higher than they are today. And so because of that, we are reporting about $1 billion less. And when you look at the detailed results, you'll see that we're $1 billion lower in terms of FX income over last year. However, I think the good news is that from a fee generation, and fees will be a component of the trade finance, our appraisal fee, our customer cash management effort in terms of just volume, has grown up by about $1 billion. This is principally a volume play, not necessarily a rate play. We've not changed our rate of banking, I think, for the last 2 to 3 years? We've not changed our rate of banking. Most of you, if you're our customers, our tariffs have remained the same. So that fee growth is not because we've increased tariffs, but it actually talks to the fact that we have increased the volumes, and our customers are doing a lot more volume of transactions with us. The digital lending side, if we compare to where we were last year, slightly slower digital income on the non-funded side, but that talks to principally Fuliza. Yes, volumes are up, but the rate, if you recall last year, September, there was an announcement about a rate reduction. So that talks to that rate reduction from that particular product. And as we look at the other side of the income statement, really is our expenses. I think there's been conversation here about our continued investment to support our customers, be it expanding our network, be it modernizing our technology, whether you're just improving it for hygiene or to enable customers have a better experience, be it the 1,000 plus employees that have been added over the last 3.5 years since we merged. Now, all those obviously are investments and they do come at a cost. If you recall, 2 years ago, we did highlight that our target short term is a cost income ratio of about 45%. Why? Because you're investing and you expect that those investments will start generating income in the future, not immediately, right? If you open a branch today, you don't expect that that branch will become profitable immediately, but you do expect that in 18 to 24 months, that branch becomes profitable. So in the first 18 to 24 months, you're carrying more costs than revenue. And I think that investment is what you see sort of contributing to this increase in our expenses. But secondly, certain expenses are also foreign currency denominated. Most of our technology costs are foreign currency in nature in terms of that's the annual maintenance costs you pay are foreign currency based. We all know where the currency is. You'll have almost a 10% increase in costs just because of the currency shifting. And as we've seen on the fee income side, our volumes have gone up. The volume of customer transactions we're processing, the number of customers, our customer retention, then that means the cost of producing and serving the customers has also increased. So when you look at it from a combined perspective, yes, the group is at 46% cost income ratio, but it's not out of our target range. I think this is within our target range in the short term. In the longer term, we will bring that down that ratio to 40%, especially when you start seeing those investments contributing to the top line. And I think as I get to the end, the group remains very, very well capitalized. If you look at that graph, it shows you the group and the various banking subsidiaries in the various markets and the regulatory ratios from a total capital perspective. But this really speaks to a couple of things that the group continues to generate sufficient internal capital. Despite the return that John did mention, there's an interim dividend of 1.75 shilling now. Last year, if you all remember, we paid a total dividend of 4.25 shillings. So that is off our capital. And the bank is growing. So from a credit assets, risk-weighted assets are growing. So despite the group's growth and the banks in the various markets, I think that capital generation is sufficient for us to be able to not only support clients from just being able to extend credit, but also to meet any regulatory minimum requirements that would be in the marketplace. I think you see that Rwanda probably has a very thin buffer over the regulatory requirement. But as I mentioned, this is a business that is growing extremely fast, and I think we are actually rethinking, and we may need to do another capital investment just to tap into that growth and support that business to grow faster. And that's the reason for that slightly less than the other markets, 1% buffer than the other markets. I think last time we were here, we talked about Uganda and the changes that Uganda had made on capital requirements for the various financial institutions. If you all remember, interim was 120 billion Uganda shillings is the current capital requirement today, but that was going to be increased to 150 billion by June next year. I think we are confident with the performance of that subsidiary that they'll be able to generate that profitability internally and fund that new capital requirement without the group having to make that injection. And lastly, our strategy is definitely delivering the desired returns that we set for ourselves. We've almost doubled return on equity. If you look at 2 years ago, 12.5, our full year, I mean, this is annualized, is about 21.7% based on our half-year performance. And similarly, our return on assets at about 3%, which is an annualized view, is almost double over where we were 2 years ago. So that execution of strategy is actually bearing fruit, and you can see it from the results we've released today. I think probably John, I'll ask John to come back, but yeah, thank you for listening, and I hope you have some good insight about what our performance drivers have been. Thank you.
All right, thank you, David. I think you've all gotten hopefully a very good idea of how the first half has been for NCBA, and of course for the market messages, which I think have all caused today. We're 20% last year, and I can tell you, you don't have a plans, but I can ahead of investments. I talked about that we're doing. This is that we are investing. The numbers I mentioned to 6 of them, we're in the right places. And I think Louisa talked about the deep. All are being delivered between 15 and 25 million shillings. All the branches that we've been opening. More digitized experience, customer experience. Again, you saw the numbers. They speak for themselves. 36% growth year over year in terms of the number of our customers that have almost fully transitioned to using digital. 99% that have joined the bank in the last 1 year have all been on board onto mobile and are active on mobile. So those are some of the things that we're doing in the background to ensure that the cost. Then about the financial performance, I think David has gone through it quite in detail. A bigger balance sheet, and so all the good things that would happen with a bigger balance sheet, again, coming through. And lastly, that we have kept to a promise of returning cash to shareholders, declaring an interim dividend of R1.75. I think so far is the highest of anybody that I've seen declare interim dividends. So again, we continue to deliver for our shareholders. So with that, I think we're now going Q&A. But before I sit down, I also want to say that obviously we talk about great results and what we have done. We talk about the staff that I talked about, 3,300 staff. But I also have to thank the people in this room. I think we have gotten very good coverage from you all. You've been very gracious in the way you've talked about NCBA. And for that, I want to be very thankful. You've taken your time. Some of you analysts, you've taken our time to understand our numbers. And for that, I'm really, truly grateful. Because without your support, this message will not go out there. So I really want to appreciate you and to thank you for even taking the time to be here with us today. Asanteni.
Our executive team, thank you very much for a detailed presentation of our results. This was actually a masterclass in one of the leading banks that's doing quite well. There's a reporter today that asked me, are the results good? And I was like, let's wait and see. BD, I think we're on course. But what this means is if we do well as a bank, then our customers do well. So we are certainly ready to support the initiatives, the pains of the macroeconomics to make sure that our customers also succeed. I'm going to ask the team to remove the podium so we can get our panel up. Mr. Gashora, David, Raphael, and Louisa, if you can join us on stage. I will ask Natalie and Evelyn from our Oxygen Communications team to help us with the questions. It's been a robust session, and I believe enough information has been shared. However, I know there's some analysts on the floor and a few journalists that also wanted to ask some questions. So please go ahead. Natalie, Evelyn, let's collect them, and then let's get our team on board. I will ask the media houses to ask their questions. Please introduce yourself and also confirm who you're directing the question. Anybody wants to go first? Yes, hello, everyone.
Hello, my name is Linda Koskei from K24 TV. And they have two questions, and the first one will go to Louisa, Head of Strategy. You mentioned about the contribution of Fuliza and M-Shwari to a tune of 40 billion, especially from the Mama Mbogas. So just to get some clarity a little bit about that, is the number for MSME representation, or who specifically contributed much to that 40 billion? I don't know who will take up this, but anyone. Kenya will be hosting the Africa Climate Summit. And are there initiatives undertaken by NCBA in regards to climate financing? Thank you.
Thank you, Linda. Indeed, that 40 billion that you spoke of is a function of both SMEs and individuals. I think one must remember that in Kenya, we're the side hustlers, right? Today you show up as an individual, and then in the evening you're running a small tomato business on the side. So from our perspective, the most important, we're not just borrowing on Fuliza or seeing is indicative that customers, really small at the bottom of the pyramid, are very responsible citizens, that they are putting the money away and that they're using it both to fund consumption, but then also to fund their businesses. So I think the question on is a country. The second is on your to let the cat out the bag. Tomorrow we do have a very special session specifically towards that agenda. So stay tuned. But indeed, the bank that inspires greatness is not going to be left behind. We recognize of making a job operating in making this transition.
Thank you for that, Louisa. I have a question from somebody who would like to remain anonymous. So the question is, a decline in interim. So whoever, maybe Aboga?
Thank you, Anonymous. The answer shall also be anonymous. I think John made a comment that one, if you look at interim dividend paid across the industry, and you can do the review and just see where does the NCBA dividend lie. If you recall our previous conversations, dividend has been a guidance of a range, right? We've always said the dividends would be if we do not have any compelling investments that the group needs to make, because you must invest now to reap the future, right? And so that is the second thing that determines where that outlook of dividends would lie at the end of the year. But we've always given an indicative range of, I believe, John, it was 30 to 50% of being where sort of our dividend guidance would sit at. So I think to that question, the final answer will remain anonymous, but it's dependent on these three factors. Yeah.
Morning, my name is Bella from Bloomberg News. I just want to get a sense of your NPL ratio. It's below industry average, as you mentioned, and I've seen it's come down a bit. But given the macroeconomic environment, I wonder where you see it by year end, if you're able to speak to that. And then if there's any chance that you could increase your provisions. I've seen that you cut your provisions in the first 6 months of the year. Why? And is that, are you able to see that amid the difficult macroeconomic environment? Thank you.
I guess I'll just continue. Yeah, thank you. So indeed, yeah, you're absolutely right. NPL ratio is below the industry average. We have about, our coverage ratio of our NPLs today is about 56%, if you do the math. We've always targeted to be within that 55 to 60% from a coverage perspective. A lot of these NPLs are still supported by collateral. which if you look at the provisions plus the collateral, you'd find that our coverage of our NPLs is actually well over 100%, right? But we do take recognition of how long sometimes it takes to resolve NPLs. Yeah, because one, you could be in court with a customer and you need to resolve that. Two, you could be trying to dispose of collateral and that takes time. Or three, you're just trying to work through with them and they're restructuring their business so that they can get back onto flight. So the question about impairments and whether we have reflection of really the quality of our portfolio as opposed to a cut in impairments. It's a reflection of when we stress and look at our portfolio, what we're talking about. Post-COVID, I did mention that a number of customers obviously were kind of stressed and went into restructures, and we've seen a number of those actually perform. But we've also been able to make certain recoveries from some of the distressed names. And so that has contributed into that lower impairment number. To your last question about where are we heading, I mean, obviously there's headwinds ahead. With a challenging macro environment, it's likely, with the rising interest rates like Raphael talked about, it is likely that you'd find certain pockets of customers could have challenges, right? And so it would only be necessary that we work with them and support them in restructuring their businesses to be able to continue meeting their obligations. But there's a likelihood, obviously, that you should see some stress across the industry in terms of a credit portfolio. And I think it's showing up. The last 3 months that the central bank has released the NPL ratio for the industry, it has been trending upwards. It's been trending upwards. So that definitely shows that there is some stress in terms of just the credit portfolio across the industry.
So my question is on, there's an observation that I've made that the banking sector has largely been driven by financial inclusion for the past several years. But it seems like now is the last dance for financial inclusion. We are moving to financial empowerment. So what is your assessment of that? Because already I can see that in your NCBA now app, you already have investments, insurance, and you're also leading when it comes to collective investment schemes as NCBA group. And honestly speaking, the banks that seemed to have done very well during that financial inclusion era, they seem close to being helpless. So they have to figure out ways. So how do you always, as NCBA, figure out the next moves? Because I can see in 2004, you are the first bank to get into bank assurance. In 2006, you are part of the mobile money revolution. And then look at financial empowerment, assets management, bank assurance, it seems to be very solid. So how do you always figure out this?
Robert, do you want to introduce yourself?
Yeah, so my name is Robert Ochieng. I'm a CEO and co-founder of Abojani Investment. So we do a lot of insights in the banking sector.
Thank you for that question, Robert. So banking sector driven by inclusion or empowerment, that's the question, right? And what we're doing at Kenya especially, and I know we are a group, but I guess the question relates more to Kenya. As you say, we were the advent of financial inclusion through M-Shwari, mobile banking. We were the pioneers of mobile banking in this market, and many other things that we do. And if you look at the statistics today, they say financial inclusion in Kenya, it's somewhere around 86 to 89%, which is, I believe, second highest in Africa. So we've done very well as a country as far as financial inclusion is concerned. And you're absolutely right. Then the next frontier becomes financial, really be the ones doing hustler fund. But we're very proud that Hustler Fund has used the work that we have done on financial inclusion to then empower the customers. So absolutely, it's moving from inclusion to empowerment, and I see Hustler Fund as being a very good example of an empowerment tool. What is NCBA doing? I think one of the things we've shown there is Loop. And I think Louisa talked about Loop quite a bit. And when she talks about Loop, she called it a super app. She also, we don't talk about it as a banking product. We talked about it as a super app, as a platform. Indeed, the way we have configured Loop is that you don't have to be a customer of NCBA to use Loop. You can connect from any bank today in Kenya into Loop. Your ATM card, your debit card, your credit card can be linked into Loop no matter which bank it comes from. And so you can cheaply transfer your funds from any bank, from M-Pesa and from elsewhere. We're also providing that as a payment tool for what we call micro merchants. If you know, what we're trying to create here, if you go to China and you buy, you know, here we all buy maize from the side of the road. I don't know if you do, I do. I don't know how many people do it. When you're buying maize from the side of the road, what do? To get on your M-Pesa, maybe ask them for their phone number, you know. But if you go to China, they don't have that. What they have is the same way you have a badge for work. They have a badge, but the badge is a QR code. So they just come close to you, you just, read the QR code and you pay. That is what we are trying to create. One of the things we are going to roll out within Loop, which creates that empowerment so that those vendors on the side of the road don't have to keep giving their phone numbers, can still be transacting as you pay them. You can pay before you pick your product. And those are some of the things that we are doing. So that's one. The second thing is that, again, on Loop, is moving from microcredit. Today we do Fuliza, which is, you know, a very small amounts, what we call for daily consumption, buy now, pay later, essentially. Then we do M-Shwari, which is up to 70,000. That's supposed to be a bit longer, 30-day loan. Within the bank, we do what we call NCBA as a loan, which is also, we are raising that to about 140,000. Again, empowerment loan. But now beyond that, within Loop and within the bank, we're doing what we're calling credit for all. And that means within Loop, you can easily borrow 1 million shillings. And indeed, we're actually going to open that to 3 million shillings on Loop. On the banking side, again, we're moving from the 140,000 to about, I believe it's 3 million, to about 3 million. Again, going into that empowerment conversation that you talked about. Those are just some of the examples we have. We have very many others, but I like that term, moving from inclusion to empowerment. Thank you.
My name is Steve from Secondary. Congratulations on the results. I have two questions. One, I've seen a lot of conversation around the turnaround in terms of when customers are applying for loans. A lot of people have been complaining that banks take a long time to approve loans. So I didn't find out what's the turnaround for NCBA. And then two, you talked about how the business economy situation has been very tough, not just for the bank but for the customers. So you've seen a lot of an increase in performing loans. You've seen a lot of, when you look at the papers, you see a lot of customers being auctioned. So my question is, the second question is what's the bank doing to help customers avoid getting into such a situation where you have to go to court or auction? Thank you very much.
So let me try to answer that and ask my colleagues to jump in to assist as well. In terms of turnaround time, I think that is, wow, that would be a complaint for a long time. Yeah. I talked about this credit for all. So what we're doing with credit for all is using machine learning approve customers on the go. Yeah, so customers that want to borrow up to 3 million can basically almost get their credit at an instance. Okay, There's still going to be some requirements to deliver some requirements, but as soon as you do, you'll be approved. And so that's on one side. And that should, in our own estimation, it should bring credit approval for those who already are customers of the bank, should bring it down to, we do 15 seconds on asset finance. We believe we can do the same on the unsecured credit side. Obviously, if there is security to be provided, although everybody complains about the banks, often it's not the banks. It's actually the process of securitization. And that's a government process. Yeah. Today, I think you've all had people complain about lands office taking a year or more sometimes. From the point the bank approves you to the point you can actually get to your money because of the process of securitization. So when I say that the complaints will continue, is because the process of lending, end to end, has very many players in between. Yeah, just like people complain about, they say, if you look at the initial fees for lending, whereas the bank will talk about it's 1%, you'll have the lawyers have their 1%, you've got the valuer with another 1%, you've got someone else with a 1%. So everybody talks about the bank costs, but actually the costs are mostly from somewhere else. So I'm not trying to excuse banks. There's a lot of work for us to do. Yeah. And I think for us, this lending for all product or program that we are launching is really to try to address that concern. Your second question was on how we are helping customers. I think I've been one of the most vocal CEOs about the fact that, I hate to look, and I say that represent wants to be out there selling property or vehicles or anything. We are very bad at it. We don't want to do it. Yeah, I think that people need to understand that banks don't want to be auctioning anybody's assets. But it's been a tough time, and we're using a lot of alternative dispute resolution mechanisms. So spending a lot of time with the customers, talk to them. Yeah, because what happens is they run to court. That takes forever often. So it's really installing and instituting alternative dispute resolution mechanisms so that if there's an issue, the customer will come in, we'll afford them the time, we'll have independent, we call them independent, but they are not the colleagues from the bank who may not have all the history of the case. They'll sit there, listen to it, and help us come up with a suggestion to the customer that makes sense for them and also for the bank. It's also always wearing the hat of an advisor to a customer. Because whether the customer is in trouble or whether the customer is new, the role of a banker is always to be a steward and to make sure they're giving them advice. So we spend a lot of time with, at least I do, I have to, that's part of my job. I spend a lot of time with struggling customers, just literally just giving them advice. This is what you need to do. I suggest you handle your problem this way, and we'll give you this amount of time to do it. If you need help, this is how we help you. So that's what we're doing. And I think we have indeed seen a pretty big reduction, at least from our side, on the number of customers. Yeah.
John, if I may, Steve, on the question of SLAs and how we lend and how quickly we lend, as John highlighted, clearly some of the processes are outside of our control in terms of the land registry or lawyers and so on. But that which is within our control, I think a lot of banks mostly focus on the front end experience. Do you have a glossy screen? Do you have a glossy branch experience? But then the back end can be very messy. So the investments that we're making in robotic process automation are to relieve some of those handover problems so that you're not having paper moving from one desk to another because you had this on this day, and all of the manual friction of lending. To the extent that we can, we are automating that just so that we can control and deliver a better experience within that which is within our control.
My name is Kibak Said from TV47. My question is to the economist who said that the economy is bound to grow by 20 basis points or has grown by 20 basis points. However, it's going to plateau very soon. So what are the trends, considering that the Monetary Policy Committee is going to be making some changes? What are the changes that we should be looking forward to in the base rates? And also maybe if you could just tell us how exactly are the end year results going to be looking around for NCBA?
Well, thank you. That's a good question. So the MPC did move, stayed flat at 10.5 from a previous 100 basis points rise. Our expectation is that they will hold for a while to the remainder of the year. Here is why. The target is inflation at 5%. It's averaged about 9% for half this year. But in the July number, the monetary policy actions stemming 10 months ago have paid fruit, dividends, and is back to within band. So the upper band is 7.5. So with inflation at 7.3 within band, the option that the committee always has to address is balance between growth and inflation. All right. So I think their stance right now has to necessarily move towards attempting to support growth, especially if you take the view that on a baseline level, we expect growth to close at just about 5%. So the optimal growth number for Kenya is about 6%. So you're having a negative output gap of about 100 basis points. Requires supportive monetary policy, which means if they had the chance, they'd actually rather be dropping rates like you've seen in Uganda. So our expectations from the MPC is that they hold at 10.5 until we move closer to the 5% target. And the Q1 numbers are giving us hope. And of course, leading indicators for Q2 as well is pointing that those processes are coming in place. Keep in mind, though, that the risk to that outlook remains macroeconomic stability, and particularly stemming from the FX risk side. So currency risk is what they are seized of right now, and that remains the risk to that outlook. But on a headline level, that's how we see it now. Of course, that impacts financial sector performance, as I think GMD did illustrate already. If you have an upwards shift on the business cycle, your numbers necessarily benefit from that tailwind. It pushes you up a little bit. The converse is also true. So assuming that our flat assumption with regard to growth tarries, which is a 5% growth, you can then see that the numbers that we're releasing today and banks are releasing, of course, will speak to that. But let me say this. I think there's also a significant development with regard to the MPC decision making. So first, I think John did point out that there's been a transition at the central bank and at the MPC, both at the governor level and deputy governor. What he also intoned, but maybe I need to underscore, is in their last decision, they took a raft of actions with regard to the new framework for implementing monetary policy that we think are very positive, net-net. So the interest rate corridor is a very good new inclusion from the MPC. Those of you business journalists here who pay attention, you can borrow a leaf from Uganda. They've been applying the corridor for a while. And as I did say in my remarks, you've seen some significant success with regard to how they're managing their domestic storm as well as external. So we think that it brings transparency in the monetary policy operations for us, and should, to the extent that you take the view that macroeconomic stability is essential to driving these growth objectives that we have, we then think that's a boost. But net-net, that's why we're seeing mixed signals. But on the MPC particularly, the call that we see, at least in the next iteration of their committee decision, should be flat at 10.5, and that takes us well into the echelons of Q4. So we think that for the remainder of the year, that should be the stance that is appropriate to drive all these economic variables back into shape. Thanks.
Thank you for that, Raphael. So the last question, and this goes out to David Amboga. This comes from Samson from Kenya News Agency. What measures has the bank taken to ensure the security and privacy of customer data, particularly in light of recent cybersecurity threats in financial industry?
Wonder why it was directed to me, but I'll attempt, and I guess my colleagues will. So obviously, cyber risk is topical today. Data governance is topical today. There's a couple of measures the bank has, or the group has taken. You first must have a structure or a governance structure that helps you to be able to, first of all, comply with the data governance pronouncements that have been made and establish, the right organizational framework to be able to deal with that. I think we now have a chief data officer who's been appointed for the group, looking after just how do you operationalize and implement our data framework. But then you also must make investments in ensuring that you're securing your systems. And if you looked at a lot of our presentations today, we've made significant investments on the technology side, not just from hygiene, but also looking ahead and saying, what investments we need to make on our systems to ensure that, your systems are protected against the cyber threats. I mean, many of you who run businesses know that, and even your own personal phones, you get messages from your friends telling you their Facebook account has been hacked, their what has been hacked, right? It happens to all of us, isn't it? And it's not unique just to business, that you must then have the right security, even on your personal phone. And that's the same thing for the business. And thirdly, I think we've invested on training our staff and our people and all of us in terms of awareness, putting in place control mechanisms to make sure that there are no lapses. Because a lot of these things happen because of process lapses, not because people have not invested or don't have the right structure, but somebody somewhere left the window open. And because they left the window open, somebody got in, right? That's what happens most of the time. So internal training of our people, awareness, sensitization is something that we've also done very seriously. So I think we continue to be alert because this is not going away anytime soon. I think there are people out there who wake up every day and their work is to see where can they get into, right? I don't know how many of you here sleep at night with your door open. How many people leave their door open? There's two steps. Some could leave it ajar, or you close it back, but you don't lock it, right? I'm sure leaving it ajar is zero. Closing it and not putting the key, maybe a few of you forget once in a while, but most of the time, some of you even check thrice before you sleep, right? Is that door locked? Is that window closed? And there's no difference when you think about how you to secure your systems from a data breach perspective. Thank you.
Thank you, David. We've now come to the end of our formal briefing today. John, do you have any final comments?
Oh, sorry.
No, not really. I think the questions have been quite informative. Again, as I said before, I hope you've gotten a good view of the type of delivery that we're doing at NCBA. Obviously, I really like the fact that nobody asked me a question today, which tells me you do share my feeling of strong management, taking this group and this bank forward. And lastly, as I thank everybody, I think I forgot to thank the bloggers because I've seen you've been very busy. And I want to thank you for the comments that you're making. Again, letting everybody know what we are delivering. I think there was a question about dividends that I wanted to talk about just a little. It came from Anonymous, and David gave an anonymous answer. But what I wanted to say is that we are really true to the fact that we have a very clear waterfall of how we apply what we call excess capital. Yeah, first of all, it's obvious to meet all the requirements that the regulator may have on capital across the group. The second one is to build the buffers that we believe in internally. We don't like to sail too close to the wind, so we like to build significant buffers. And I think David did show on a page what kind of buffers we have across the countries. And I think what he said was that we're actually looking to put money into Rwanda, because there we have very thin buffers between what the regulator requires and what we require. The third one, and a very important one, is that we give priority to investments that are compelling investments. Interim dividend is done with the recognition that there are certain investments we may still be looking at. So we obviously look at various investments, and there are a number of them that we are considering beyond the ones I have shown about the branch investment and other things. There are others that we're looking at, and those, if they crystallize before the end of the year, then they will determine what we do to the end of year dividend. But they certainly inform what we do for the interim. So I think I just want to make sure that everybody understands that there is a strict waterfall that we go through before we decide on interim dividend. So thank you very much.
Thank you, John. Thank you to our executive team. We've now come to the end of the formal program. Thank you, media houses, everybody that's represented here, Asanteni, for bringing out publication, sharing the news to the public, and obviously sharing the narrative on the performance of the bank. The NCBA team, Asanteni, for again putting together a wonderful event today. We wish you a good day, and before we leave, we will have a photo session. So the executives, please line up. We're going to have a photo session at the front. There's a guy that wants, I know you always want this picture, right? So we'll have the photo here, and then after that, we'll have John move to that side for some box spots, right? For the media team. Thank you very much.